My name is Samuel, an investment analyst with Phillip Futures, and today we will actually be talking about the Forex market outlook for the second half of 2019. So before we begin, just a little disclaimer. It's just that everything you said today is solely for education purpose only and does not constitute to any form of financial advice. So without further ado, let's go into the seminar proper. I'm an investment analyst with Phillip Futures, so I specialize in the financial markets, mainly the equity indices as well as the Forex market. Day to day, I actually publish commentaries and it's actually sent out to our clients. You may have also seen me on the TV, heard me on the radio, or seen my commentaries on the newspaper before. So for today's seminar, very simple, we'll be covering the major currency pairs. We're going in the order is the first half 2019 recap, followed by the view and forecast for the second half of 2019. So just to ask everybody, have you all been in the Forex market recently? I'm sure if you all are, you all have been facing quite a lot of volatility because recently markets have been quite interesting. There have been huge swings due to various events happening. So let's talk a little bit about the US market. For the US market itself, if we look at the US dollar index futures, we can see that the first half of this year itself, basically up to last week, we saw they actually increased around 2.07%. So actually, a lot of people were caught off guard because that being said, a lot of people were expecting that dollar is going to weaken at the start of the year. But what actually caused the dollar to strengthen? Well, it's just these few factors. Firstly, is that the dollar was still deemed as a safe haven currency and is also as a safe shelter for most people because we all know that even into 2019, markets were still relatively risk averse because due to the trade wars that actually started off last year itself, people were expecting softer economic numbers, etc. So because of that, it caused markets to actually flow into safe haven currencies. Second is that the Fed was not as dovish as feared. So later I'll actually share what actually people thought about last year, how dovish the Fed was going to be, and what actually ended up this year itself. And thirdly is that the US economic data actually appeared stronger than most economies, and I will share it further as well. So what actually happened last year? Towards the end of last year, even at the start of this year itself, people were expecting Feds to hold rates. So because of that, you can see that the markets were very dovish on the dollar. People are thinking that with it holding rates, there's no more catalyst that is actually pulling the dollar stronger to exist in this year itself. And we can see it apparent in a lot of speeches by the relevant authorities. We can see that the FOMC chairman has actually said that the Fed was going to remain patient and that it's unlikely to raise rates this year. They're going to keep it stable, etc. So because of that, we can see that the dollar at the start of the year weakened slightly, but this changed afterwards because even though they were saying that maybe the US economy is slowing down, what happens is that they downplay recession and they said that the US economy is still strong. So going forward with a stronger US economy still resilient, the dollar should remain resilient. And this actually caused the dollar to strengthen because of a few events that happened later, which is namely the more dovish outlook of other currencies. So what happened is that we saw other central banks have the possibility of reducing interest rates and have even reduced interest rates over the past month. So of which the two more prominent ones will be the Bank of Australia, Royal Bank of Australia and Royal Bank of New Zealand. So even up to the first quarter of 2019, what happens is that these two central banks were already talking about possibility of rate reductions. So as compared to the Fed, right, these central banks of the more developed economies as well were actually more dovish than the Fed and causing the dollar to strengthen faster. And eventually, we looked at New Zealand actually reduced rates last year. Last few weeks back, and after we can see that if you look at today's Royal Bank of Australia's minutes as well as heard what the chairman said, next month they are likely to reduce rates as well. Because of this, it actually caused the dollar to strengthen because as compared to the other central banks, the Fed is still not deemed as dovish as them. And we can see that the Fed, based on the last FOMC meeting, he does not see any strong case for rate reduction at all. This is despite President Trump constantly pressurizing the Fed to reduce rates. This is despite numbers not that we can see that recent numbers maybe not as rosy as what was initially depicted, but that being said, it's still the Fed still remains very strong on this view, and that it does not see a case for either a rate reduction or a rate hike. So if it's going to maintain status quo, it's showing that the dollar, it caused the dollar to actually strengthen as compared to the other currencies throughout the first half of this year itself. So we can see that the Fed also remains very defiant, not listening to what President Trump has been saying. President Trump has been constantly calling the Fed to reduce rates by 1%, calls for more quantitative easing. In fact, Trump said that if Fed were to reduce rates, the US will have a better advantage in the trade war because China's side has been constantly supporting its economy. So the US actually wants the Fed to actually help the US in terms of that aspect as well. But that being said, Fed has refused to listen to any of this and has been very focused on economic numbers. It has constantly stated that as long as economic numbers are strong, the economy is resilient, we will keep rates unchanged, or we will adjust the monetary policies accordingly. So we can see that this year itself, the Fed has been having a press conference after every meeting, so it has given more clarity to the public on the Fed's decisions as well. And we can see that if you look at the first half of 2019's economic numbers, we can see that the US economy is still doing slightly better than the other economies as well. So if you look at this is the GDP, the latest GDP numbers. If we compare it to Australia, compare it to the EU, compare it to China, we can see that most economies in terms of GDP, they are slightly drifting lower. But that being said, the US economy is still rising. So because of that, it shows that in terms of economic data wise, US, even though globally we are still overall seeing a slowdown, but you can see that the US side, as compared to the other nations, is still quite resilient and still going strong. So if you look at the unemployment numbers are also at an all-time low. We can see that GDP growth have been relatively stabilized, and you can see that it's still going strong as well. So with all of that in place, people are actually not that worried that the US will suddenly slip into recession, because in terms of economic numbers wise, they're painting a more rosy picture. We can see that manufacturing numbers, which is one of President Trump's focus, you can see that for the since actually 2016, it has been on expansion and is still expanding quite nicely, even though it has slowed down in the recent months, but it's still quite okay. So, but going forward, what we feel is that actually downside risk is imminent, because what happens is that we can see that the trade war has actually caused non-confidence towards the dollar. So we just talk a little bit about the trade war. What happens is that ever since around 3 weeks back, whereby President Trump actually reignited the tit for tat tariffs against China, whereby it stated it want to put more tariffs on Chinese products, it has caused the trade wars to come back into focus, and it has caused market jittery to emerge. This has resulted in people maybe not having that much trust in the dollar, because the dollar is ultimately one of the direct instruments involved in this trade war, because it's between US and China, you see. So US dollar is more or less affected, and this has caused a fund flow to other safe haven currencies like the yen. So if you look at the dollar yen comparison, you can see that the yen has actually strengthened over the past few weeks as compared to the dollar, due to the trade war escalation. And going forward, the trade war escalation is not expected to end anytime soon either. Why is that so? Because if you look at it recently with the Huawei backlash and everything, we can see that both sides have not shown any forms of sort of like have not shown any forms that they would like to give way to each other. Both are very persistent in their views. This is very similar to what happened last year at the start of the trade war. And you can see that recently, President Trump's stance has become much harder. If you look at his recent interview over the weekend, he stated that for this trade tariff thing, it's not a 50-50 game. China must give way more to the US before the US will accept the deal, etc. Because of all of this, we can see that it's unlikely China actually giving to threats, and China will negotiate an unfair deal for itself. So with that in place, trade talks have stalled so far. There's no further updates to when the next trade talks will be. Eyes will be looking towards the G20 summit, whereby President Trump and President Xi are due to meet. So if they actually meet, then hopefully something nice will actually turn out of the whole thing. If not, we can see maybe the dollar strength will falter further. Second is that actually there's still a possible rate reduction going forward, and I'll explain why is that so in the next few slides. And there's also worries of slowing domestic and global growth, as well as tame inflation, that will actually weigh on the Fed's confidence, and this may actually result in rate reduction. So if we look at it, actually markets are looking towards a rate reduction recently. Why is that so? Is because if you look at the Eurobond, you're looking at the Eurobond futures and everything like that to see the US interest rate going forward. If we look at the futures, we see that actually the futures markets is pricing a rate reduction, and you can see that the prices for the January contract is actually much higher. That it is actually slightly higher than current price. Slightly lower than current prices. So if you look at it, it's actually pricing in a potential 25 basis points rate reduction. So why people are thinking that there's possible rate reduction? Because right now we are actually already very near neutral rate. So it's impossible that they will hike rate further, because data is not growing as fast as last year. And if you look at it, right, inflation will still be key. What happens is that during the last FOMC meeting, President sort of like Fed Chairman Powell, he actually stated that what happens is the inflation numbers recently they were slightly a bit lower because of temporary things, and that going forward it's going to be all okay, even though he still stated that taking into consideration the global slowdown and everything like that. But that being said, if you look at the recent inflation numbers, it fell below expectations. It still shows that inflation numbers are still slightly weak and may not rise above their target. So if inflation numbers constantly sink and it still shows tame inflation numbers, it will actually cause the Fed to reconsider its policies and possibly actually reduce interest rates going forward. So it may not be a very immediate reduction. We may see it maybe close to the end of the year. So you can see that Fed officials are actually still seeing risks in weaker inflation and the trade wars that are ongoing. So with renewed risks, right now we see that the Sino-US trade wars are going into a full-blown action. We can see that previous expectations that is going to end is not going to come true anytime soon. It may escalate further with more tariffs placed against each other. Right now we can see that the espionage it actually has on the Huawei incident and everything, actually sort of like worsening the whole trade tensions. So because of that, we are seeing renewed risks and markets may be more jittery. So we look at the US dollar itself, you can see that actually it's still being supported by the uptrend line and by the moving averages. But that being said, you can see it actually hovering around this level, is steadying. It has, unlike last year, whereby you can see that the uptrend it has actually it was very strong. This year is more of a stabilizing, and more you can see more sideways movements. So if you look at the US dollar JPY, you can see that since the trade war actually happened, the sort of like we can see a slight retracement in the whole US dollar curve over here. So that being said, right now we see a slight reboundment, but if the trade war actually worsen further, we can see it retrace even below that. So for the US dollar, we feel that downside risk is imminent, because the trade war escalation could actually result in non-confidence towards the dollar. There's also still possible rate reduction going forward, and that the worries of slowing domestic as well as global growth concerns and tame inflation is weighing on people's confidence towards the dollar. How about for the UK side? I mean, a lot of people are right now very focused on UK as well in terms of the pound, because there's one big incident that has been driving markets as in terms of sentiments, which is known as Brexit. So we can look at what happened for the first half of this year is that the pound weakened, but weakened slightly only. So if you look at it, it's actually kept buoyant by a few factors and mainly revolving around the Brexit rhetoric. So if you look at it, one of the huge factors that everybody were very happy about was the successful extension of the Brexit deadline until 31st October. So we all know that at first, by 31st March, what happens was that the UK was supposed to exit the UK with or without a deal, but due to all the negotiations and extensions, it was eventually extended to 31st October. So what happens is that it gave people more confidence that maybe the UK is able to avoid a hard Brexit situation, because the hard Brexit is very detrimental for the UK's economy. Also, we saw that there were a few attempts to impeach Prime Minister Theresa May, but they were unsuccessful. So because of that, it actually gave a little bit more political stability to the UK itself, and it caused the pound to remain stable. However, what actually caused the decline is the loss of business confidence towards the UK as a whole. Businesses were more wary because they did not know what to expect after Brexit. We can see that the Bank of England's decision-making process was also affected by the whole Brexit process, and they are not able to put due monetary policies in place as well. And right now, we are also still looking very closely to the what's happening in the Brexit situation, because it's going to dictate where the pound is actually heading. So it's very much news driven at the moment. So if we look at economic numbers in the UK, we can see that it's actually drifting lower this year. It dropped slightly, but it's still quite weak as compared to the past. We can see that the recent data showed slightly a little bit of going back into the expansionary territory for the service PMI numbers. But if Brexit actually were to happen and a hard Brexit happens, then all the numbers may drift differently as well. So GDP growth, we can see that it's still quite lackluster as compared to 2017. So what happens is that the main reason why 2019 they shot up slightly a bit higher is because last year was extremely weak. So this year, due to the lower base effect, it actually have a sort of like false positive number. But if we look at the overall, we are still seeing a relatively weak British economy. So going forward, we feel that in terms of our view for the pound, we are actually very cautiously pessimistic about it, because there's still the possibility of a hard Brexit happening. In fact, the hard Brexit rhetoric has becoming more prominent of late, and it's possible that after the deadline, a hard Brexit will happen. This is due to three main factors. Right, the first thing is that the cross-party talks between the Conservatives and the Labour Party have actually collapsed. So what happens is that before that, in terms of when they were granted the extension, people were hoping that actually Theresa May was able to have a good discussion with Jeremy, the Labour Party's head, and they are able to come up with a solution that both parties agree on and propose to the EU, and in turn forming up a plan that will actually give them a smooth exit from the UK. Because what happens was the initial failure, the previous round, was due to the largely divided parliament. However, even after weeks and weeks of discussion, what happens is that it eventually ended up in failure late last week. So this actually resulted in the Labour Party actually coming up to strongly say that they're going to oppose anything Prime Minister May has actually proposed, which will actually cause history to repeat itself. So because of that, if really things were to repeat again, whereby they are unable to come up with a consensus to anything and everything that is proposed through Parliament gets rejected, we can see that a hard Brexit will likely occur. Second thing is that Prime Minister May is actually due to step down in June, and her Brexit plan is likely to fail, even though she's going to put in a last attempt push tomorrow. But judging from the current situation, it's going to fail. And what this means is that if Prime Minister May actually steps down and a new person takes over her, the new person's direction may be different from her, and it will cause a huge disruption to the Brexit process. Because we all know that the Brexit process so far was sort of like driven by PMA, and she has actually struck a deal with the EU already. So if everything were to go down the drain and the process were to be restarted anew, what happens is that Prime Minister May, the new Prime Minister will have to renegotiate a deal that can pass both the EU as well as the Parliament. And given that it's just a short it's just a short 5 months left, we can see that it's quite hard for it to actually materialize, and this will give more non-confidence to people as well. And lastly, is the third point is that based on the current situation on the ground in the Conservative Party, the pro-Brexit ministers are actually gaining more favor to succeed PMA. And what does this mean? The pro-Brexit ministers are actually more they are actually more drastic. What happens is that they would like their plan is to leave to leave the EU and have a Brexit, whether there is a deal or no deal. So meaning to say, even if they are unable to secure a deal with the EU, they are determined to leave the EU itself. And if a hard Brexit really happens, the UK economy is not going to do very, very well. So even though there's still the second referendum is still a viable outcome, if the new prime minister is very headstrong and refuse to hold a second referendum despite calls for it and despite many public votes for it, we can see that if Parliament still rejects everything and the divided Parliament problem exists, and if UK and EU doesn't come to a consensus together, a hard Brexit is likely to be the eventual outcome. So if hard Brexit happens, the pound is expected to sink further. So if you look at the pound is still on a downward trajectory. It's in a bearish trend below the moving averages, and right now it's expected to find some support at the 38.2% mark of the Fibonacci retracement. So there's still some distance from it, and with the talks happening tomorrow whereby PMA is going to push her agenda through Parliament and is likely to fail, is most likely going to act as a catalyst for more downside momentum. So for the pound wise, we remain cautiously pessimistic about it because the second referendum is still a viable outcome, as well as there's still a rhetoric of a hard Brexit happening, and with a largely divided Parliament, anything being passed through looks quite bleak. How about for the Europe side? For the Europe side, we can see that it has been a terrible year for the Eurozone. It has fallen approximately 2.65% in a short span of around 5 months. And this was attributed due to a few factors. First thing is that the slowdown in the Eurozone's economic numbers is apparent, and it's seriously a very huge problem because if you look at it, the Eurozone manufacturing numbers are in contraction, and it's one of the few developed nations that are actually showing huge contractions. In fact, if we look at Germany's data, and Germany is the largest contributor to the Eurozone in terms of economy-wise, it has been contracting since the start of 2019. So this is a huge concern because if it doesn't recover, it's very unlikely that the Eurozone will see recovery in economic numbers as well, and this is going to weigh on the euro. Okay, second thing is we can see that the ECB, the central bank, is actually more dovish than expected as well. They have indicated that interest rates are going to stay low for a long time, which shows that it's not going to put additional catalyst to strengthen the euro. Secondly, is that they stated that inflation goal seems very difficult to reach, further highlighting that economic weakness is very apparent in the eurozone. Okay, so if, like example, Brexit really were to happen, it would impact the eurozone slightly a bit more as well, because they would lose their free trade agreement with the UK side, and they will have to restrike some alternative measures. But then if you look at it, you can see that in the long run, if economy is not going to do that well, the eurozone, the euro is going to falter further. So we can see that Italy's is also a huge concern, because Italy is the third largest economy in the eurozone. So its public finances has been deteriorating, and it's reportedly actually going to break the EU's regulations this year unless the policies are changed. So we know that last year what happens was the Italy's debt crisis was a huge thing and caused turmoil in the eurozone as well as the euro. And right now, with history expected to repeat itself, we can foresee more downside potential in the euro as well. So we can see, if we look at the manufacturing index, we can see contracting already since February this year in terms of the eurozone one, and you can see that it's in a huge decline, with showing no signs of actual recovery at all. We look at the service manufacturing numbers, we can see slight recovery, but it's still because eurozone is quite dominant in terms of manufacturing, it's still not that beneficial yet. Inflation rate we see is still falling below the 2% target. So with that in mind, the ECB has stated that inflation target is still quite hard to meet, so this will be a key risk for concern as well. Whereas if we look at GDP growth, it has been declining, not very fantastic at all. So going forward, we feel that much will be dependent on the data as well. First thing first, we have to note that there's still a potential EU-US trade war ongoing, all right, because the US side has actually threatened a few times to implement automobile tariffs on the EU. So we do know that EU is famous for its automobiles in terms of exporting. So most of the cars are from EU itself. So with these potential tariffs being implemented, if it's indeed implemented, it will cause a drastic dip further in the EU economy itself. So right now, although there has been a postponing of the decision by 180 days, because President Trump do not want to escalate the trade war further, but then we can see that if nothing conclusive is reached between trade talks, which has not been going well between US and EU so far, we can see that maybe after 180 days, the US may make a decision and may implement tariffs on the EU. If that's the case, more downside for the euro actually entail. So we can see that the slowdown in the economic numbers are expected to continue also. The Germany's manufacturing and factory data actually shows no signs of picking up and shows continuous contractions. So all of this is all very worrying. There has also been constant riots in France and is expected to weigh down the French economy. Also, we look at Italy. It has been failing to meet economic targets, and debt has been exceeding the targets itself. So all of this is worrying, because if the economic situation in Italy worsens further, it may actually spark off a Greece crisis, a Greece-like crisis that is going to impact Italy. And because Italy is the third largest Eurozone economy, the impact will be greater. Also, we can see that the ECB is still relatively dovish. So what happens is that it has cut its 2019 forecast, predicting an expansion of a mere 1.1%. Also, that it has changed the rate guidance and announced a new cheap round of bank loans sooner than expected. So all of these are very dovish signs. We also note that actually the European elections are actually occurring later this week on the 23rd onwards. So this actually poses a little bit of pressure to the Eurozone as well, especially with this year. What is actually happening is the far rights are actually gaining power. So what happens is that the far rights actually want to dissolve the Eurozone. So if really a lot of far rights were to be elected into the Eurozone, the European Committee, the EC itself, we can see that going forward, the direction of the EU may change. So right now, if we're looking at the euro forecast, we can see it's actually stabilizing at the 38.2% mark. It shows some signs of testing the support. Once the support is broken, we can see it maybe reach the 23.6% support as well. So we can see right now it's still in a downtrend. There has not been much reversal signal, so it shows that maybe a downward trend is likely to continue as well. So for the Eurozone, actually much will be dependent on data going forward. This is due to the potential US-EU trade war. The slowdown in the EU economic numbers is also expected to continue, and that the ECB is still relatively dovish. So for the last currency of the night, we're actually looking at the Singapore dollar. So for the Singapore dollar itself, we can see that it has actually weakened over the past half a year against the US dollar per se. Why? Is it because the 10-month long trade war has actually rippled through our export hub economy. Because we all know that Singapore is very export driven. We rely a lot on trade. So what happens is that with the trade war ongoing, it has actually reduced demand of our goods, because what happens is that there's a trade slowdown globally. So with that, it has impacted the Singapore dollar as well. We can also see that our NODX numbers reducing greatly, our GDP numbers slowing down as well, and I'll show it that later. Secondly, we can see that the MAS has actually paused tightening our monetary policies in April. This is slightly against our expectations. And what happens, they left monetary policy unchanged. So because of that, we can see no catalyst to boost the Sing dollar stronger as well. And overall, we have weaker economic numbers this year as compared to last year. And we can see that the global slowdown is quite apparent this year. So we can see that the NODX numbers, even today's even last week's released NODX numbers, we can see it's actually minus 10% year on year. So you can see that it's this year, right, we have been constantly in the negative zone. We only saw 1 month of positive numbers as compared to last year. So if our NODX numbers reduce further, it will actually cause negative revisions on our GDP forecast as well as our growth this year as well. And all of these are expected to affect the Singapore dollar. So if we look at GDP growth, we can see that actually it has been revised lower just this month due to our numbers, our sort of like manufacturing numbers actually still being very weak. So all of this will actually weigh on investors' confidence as well. We can see even though inflation numbers have been stable, but it still doesn't really give that much confidence as well. But going forward, we still think that the Sing dollar is going to be resilient, because why? It's still deemed as a safe haven currency for Asian economy. So if you look around the ASEAN side, the Sing dollar is still relatively stable as compared to the emerging market currencies. And then we can see that in terms of the ASEAN side, a number of our neighbors are actually having elections this year, as well as just like the recently passed Thai elections as well as the Indonesian elections. And all of this have caused ripple effects in their economy and in terms of their currency as well. We can see that Malaysian bank actually recently reduced rates as well. So all of these are negative factors, but Singapore, we are still relatively resilient and stable. And we can see that maybe in terms of compared to the US dollar, we may not be that strong, but as compared to our ASEAN currencies, we are still deemed as resilient. So we are still much stronger than the outlook for Singapore is still much stronger than other emerging market currencies as well. So all of this will actually drive the dollar stronger against the ASEAN economies. Next, we actually recently announced efforts to gain more global interest with regards to the Sing dollar, with the MAS actually aiming to release data comprising of its net purchase of foreign exchanges on a 6-month basis. This actually further enhance transparency and will give more confidence to investors who would like to invest in the Singapore market in terms of currency wise. So if you look at it, we can see that the recent against the Sing dollars, the US dollar recently had a breakout and it's actually quite strong. So it may actually find some resistance along this level, the previous high, but we still feel that overall the Sing dollar is still quite resilient and it may not actually break past the 1.385 levels. So maybe you can test around the previous high, then start to retrace a bit and maybe go back down to around these levels based on technicals, because we can see that the upside is is a sudden spike and it may not be that strong lasting. So just to conclude, we'll just do a recap of all the currencies we have said so far. For the US dollar, we are actually feeling that downside risk is imminent because the trade war escalations could actually cause non-confidence towards the dollar. There's also possible rate reductions going forward in terms of the Fed's decisions. There's also worries of the slowing domestic growth in the US as well as tame inflation numbers. For the pound, we remain cautiously pessimistic because there's still a possibility of a hard Brexit happening. In fact, it's getting stronger. Even though a second referendum is still a viable outcome, it's still dependent on the new leader that's taking over, Theresa May. And coupled with the largely divided parliament, we are of the view that it's unlikely anything could be passed through this parliament. And because of that, if nothing is passed, a hard Brexit could be the eventual outcome. For the euro-wise, we feel that much will be dependent on data going forward because there's still the potential of a US-EU trade war. The slowdown in the EU economy is also expected to continue, and that the central bank of the European Union is still relatively dovish. For the Sing dollar wise, we feel that there's resilience in the Sing dollar because it's a safe haven currency for Asian economies. It's still stronger against most other emerging market currencies as well. And right now, the MAS is trying its best to put in effort to gain more global interest. So with that, if you are interested in trading Forex, our MT5 platform actually offers many opportunities for you to trade Forex. We have tools available such as auto charties, which enables you to do pattern recognition, and there's zero commission. It makes it more competitive for trading as well. And with that, I end my presentation. Is there any questions for me? Thank you.
Thank you, Samuel. We have several questions here. Maybe we have actually answered the one about the tariffs. So maybe on the Brexit issue, one of the people in the audience wanted to know why the new PM candidates for the UK elections, why are they adamant on a Brexit solution, whether it's a deal or no deal, despite knowing that this will adversely affect the UK economy? What are the reasons that's driving these candidates to be pro-Brexit? Maybe Samuel, you can enlighten us a little about this.
Okay, so if we're looking at the candidates who are actually trying to replace PM Theresa May, if like example looking at Boris Johnson and the other front runners, we noted their stance to be very different from PMA because PMA is looking at a solution whereby they are giving in to the EU so that they can ensure a sort of like peaceful Brexit solution, whereas they are more adamant on what they desire because they want a clean Brexit to happen, meaning to say they do not want any ties with the EU or EU controlling any of their borders. So if that's the case, EU has stated on many attempts that they refuse to accept that, and if the UK is not able to come up with a good solution, there's a good chance that a hard Brexit will happen. And what happens is that these leaders, they are very adamant about leaving the UK with or without a deal because that's what Boris Johnson has actually campaigned for the last time when he was actually driving his Brexit campaign, is that they would like a Brexit. So he has been also against PMA on a few occasions and have been insisting that they should not give in to the EU's demands and they should actually just go for it, and regardless whether it's a hard Brexit or not. So their approach is very different, and with that, there's still an increased risk of hard Brexit because of this pro-Brexit people actually dominating in terms of who is going to replace Theresa May going forward. And that's why if you look at the news recently and if you see the opinions of most people, they are thinking that the Brexit risk has increased drastically if PMA actually steps down or her plan fails, because there will be sort of like more arguments between the UK and EU on what's going to be decided, and if nothing is conclusive is going to be reached by 31st October, the EU is going to say that it's not going to extend or give any more chance to the UK, and because of that, hard Brexit will be the eventual outcome.
Thanks, Samuel. Hope this answers your question. For There's also a question from Mr. Victor Wong about currency recommendations. Samuel, your call is that most or all the strong currencies are weakening. So which pairs would you recommend for investors to take a position on, and what kind of position?
So I mean as in if you are comparing currencies, I would still say that if you're looking at more the developed currencies, like example uh I would say the more safe haven currencies as compared to the E- uh pound as well as the euro, maybe the dollar and the yen uh will will be a better option. Okay, so what happens is that I feel we have the opinion that actually the pound dollar, the euro dollar is going to see still strong weakness because of the Brexit situation as well as the EU sort of like the EU weakness situation. But if you are looking at the dollar upside, maybe the dollar is not going to have as much upside as the pound as the yen, because right now yen is also deemed as a safe haven as compared to the dollar, and if the dollar directly in competition, I mean directly affected by the overall Sino-US trade wars, we can see maybe the yen will see more strength as compared to the dollar. Yeah. So if we are looking at things like that, maybe I'm bearish USD JPY. I'm also bearish on GBP USD and EUR USD.
Thanks, Samuel. Um, we have answered all of the questions. If you have any other questions, please drop us an email. Samuel's contact information is still on the slide on your screen. You can email him directly, or you can email us at futures@phillip.com.sg. We hope this webinar gave you a good insight into trading currencies. Thank you for being with us tonight. A recording of this webinar will be made available to you over the next few days. We'll be also emailing you the slides. Thank you and good evening.